When you think about investing, do you ever worry? Probably a silly question to ask. Ever wonder why the market is collapsing? Have you ever wondered if another Great Depression may happen again and what you could do to protect against it? As we move further into the 20s and the upcoming 30s decade, we must wonder if the saying, history repeats itself, is true, especially after the last century. In this video, I'll provide detailed explanations to address your concerns, and please subscribe for more content like this. With that being said, let's start the video. The first half of 2022 was the worst in 50 years, and on June 13th, the stock market officially entered a bear market. Investors felt punked by a brief bull run in July and August, then more bleeding came, so some wonder whether they need to stock up for a complete market collapse. Two possible explanations come to mind. As a first point, it seems pretty improbable that the market would collapse completely. Secondly, there is always the chance that the market may continue to drop rather than recover. Following knowledgeable online financial gurus, like me, during a stock market decline may be crucial for safeguarding your investments and making the most of a price reduction, as well as educating yourself for the future. A crash in the market, what caused it? There is no strict dividing line between declining and falling markets, since market collapse is not a technical phrase in finance. Dropping precipitously and drastically is what this term describes. Investors suffer a financial loss when prices drop, often triggering them to liquidate their holdings to prevent future losses, resulting in a realized loss. This in turn further reduces asset values. You may see the crash as a drop on any price chart. Financial controls enacted in the wake of the 1929 stock market disaster have mostly been successful, contributing to the relative rarity of crashes in contemporary U.S. history. There was just one major market collapse in the United States between 1929 and 2000, a span of 71 years. In 1973, when the oil crisis hit, stock values fell by an average of 48%. Financial and banking sectors were deregulated by Congress in the late 1990s and early 2000s. Many laws enacted during the Great Depression were repealed or changed in response to claims that the same regulations that delivered stability also impeded progress. Since the changes, the market has fallen in 2000, 2008, and 2020, or about every 7 years, with the pandemic recovery and aftermath of massive pandemic spending now being unwound by the Fed in 2022 being the cause of the most recent collapse. With that being said, why do markets collapse? There might be several causes for a market collapse. The stock market saw notable crashes in 2022 and 1973 due to completely unrelated occurrences. Oil embargoes in 1973 caused energy prices to skyrocket, causing widespread instability and substantially contributing to the collapse. In 2022, the world saw the first global pandemic in more than a century, effectively stopping all economic activity. These disasters resulted from what economists term exogenous variables, or factors outside the control of investors, but with a profound impact on the economy. The market's direction might be affected by anything external. In extreme cases, the impact might lead to a collision. However, a collapse in the stock market is typically only a heightened form of correction. Overvalued assets or an accumulation of poor risk are the first causes of this downturn. For instance, in 2000, the internet bubble caused a lot of money to be invested in unsuccessful online businesses. In 2008, the housing market and associated financial products experienced the same fate. Stock market overvaluation and subsequent correction cycles are nothing out of the ordinary. Misjudging an asset's value is common, and when investors discover they've placed large bets on poor performers, it may exacerbate market corrections, turning them into full bear markets. Such widespread panic may lead to a collapse of the stock market. In particular, activating feedback loops may quickly transform a market correction into a catastrophe. Leveraged trading, for instance, had a significant role in the 1929 market meltdown. Investors borrowed money to purchase stocks, and as long as profits increased, they could settle their financial obligations. However, as prices began to fall, many investors lost all they had invested. As a result, prices fell even lower, prompting further investors to go bankrupt. A feedback loop may be challenging to interrupt once it has begun. Panic and fear almost always kick in at some point, and there is a lot to say about what happens next. When stock prices start to fall, investors sell to cut their losses. As a result of their sales, prices drop, encouraging even more individuals to sell, creating a vicious cycle. How bad will 2022 end up for the markets? With just over 2 months to go, the answer is solidifying. Currently, the stock market displays extreme volatility. In the first 6 months of 2022, the market saw some of its most significant declines in the previous half century. Not only did the S&P 500 lose almost 1,000 points at that time, but the Dow Jones and the nasdaq dropped significantly as well. Economists have spent many hours analyzing key indicators such as the Consumer Confidence Survey and associated polls, but it has become more difficult to trust such data. Inherent biases may skew results, and politically, one side often blames the other when things go wrong, no matter who is in charge. Consumer spending is being held back by rising inflation, rising home prices, and rising debt. With a wall of expenditures ahead as August brought the return of federal student loan installments. Of course, a significant portion of student loan debt was just recently forgiven. Inflation-adjusted per-gallon energy costs are at their highest levels since 2008. Despite that, the employment rate continues to rise, and earnings have increased, suggesting that people in the United States can find decent jobs and compensation. This also makes the current 22 recession a very unusual one, as we rarely see such a strong job market combined with declining GDP. However, the quit rate, which measures how frequently individuals leave their employment, continues to be at record highs, notwithstanding what consumers describe in polls of their financial well-being. Historically, a high correlation has existed between the quit rate and genuine consumer confidence, but some of this is undoubtedly attributed to the Great Resignation phenomenon, another pandemic-generated trend. Although gas prices have started to fall slowly, inflation seems to have leveled out, if not decreased ever so slightly. The fact that individual savings rates amongst Americans have reverted to long-term averages may lend credence to both of these hypotheses. The yield on intermediate-term Treasury notes and bonds has also climbed, and the S&P 500 has potentially bottomed out and stabilized in recent weeks. The yield on long-term government bonds like the 10-year Treasury note falls as investors who anticipate a market decline purchase them. Investors may feel more optimistic about the market if they simultaneously see increasing yields and prices. It's almost impossible to pinpoint precisely when the stock market will bottom out or start to recover. There is a risk that inflation and rising interest rates may stifle an upswing before it gathers traction, turning July 2022 into a dead cat bounce and sending the market further into a tailspin, or a robust labor market and sustained improvements to the supply chain might enable the economy to continue to grow and prosper, allowing the market to recover fast. Keeping with your current investment plan is your best bet since there's no way to predict the future. Stock market dips and even complete crashes are temporary. Investing for the long term, not just the next few months, is key. Look for long-term value using a mix of index funds and fundamentals and stay away from short-term investments. And invest regularly and reliably over time. It is impossible to predict whether or not the market will continue to decline in 2022, but it looks likely. While there is undoubtedly cause for alarm, there are also indications of underlying economic health. Investors who are thoughtful about their money should keep putting money away for the long haul and work with a more robust financial framework. Watching my videos and understanding my investment philosophy may also help you. Investing advice. It might be tough to know what to do when the market drops. Most investors can weather a market slump, but it's more difficult if you need to withdraw money at that time. It's not as easy currently to be retiring, purchasing a home, or sending children to college. If you can hold out for a year or two, you should stick with your current investment strategy. But if you need to withdraw soon, capital preservation becomes much more paramount. What is the Great Depression? The Great Depression was America's worst recession. It started in 1929 and lasted into the 1930s. October 1929 stock market collapse sparked by the Great Depression. By 1933, unemployment was 25% and 5,000 banks failed. Herbert Hoover tried to spur economic development via the Reconstruction Finance Corporation, but it didn't help. 1932 saw FDR's election as president. Roosevelt's New Deal proposed a new approach to the Great Depression. 18 months before Black Thursday, October 24, 1929, the U.S. stock market almost quadrupled in speculative purchasing. On that day and Black Tuesday, October 29th, panic ensued as stock values fell. The market crash started in October 1929. By mid-November, the stock market had lost a third of its September value. By 1932, it had lost 90%. In 1932, a $262 U.S. Steel share sold for just $22, less than 10% of its prior value. The stock market fall was one of several causes of the Great Depression. Weak banking, failing agricultural prices, and industrial overproduction caused the recession. The 1930 Hawley-Smoot tariff, which boosted average tariff rates to over 60%, led America's trade partners to impose tariffs on U.S.-made products. International commerce shrank and world economies fell. What would the next Great Depression look like? A scenario we hope to never see. Squandered possibilities, significant economic suffering, lost riches, profound regrets, and sadness over what could have been are all likely to characterize the decade from 2030 to 2040. Guard yourself. Prepare for it. Both the dot-com bubble explosion of 2001, Y2K, and the Great Recession, global financial crisis of 2008-2009, have been economic setbacks for the world economy in the first 2 decades of the 21st century. In 2030, economists worldwide anticipate we will see a global economic downturn similar to the one that followed the Spanish flu pandemic. Industries and businesses that thrive due to the stimulus and societal restraints brought on down by COVID are now struggling as demand declines and inventories catch up with or surpass supply, causing localized areas of economic contraction. Retail sales, employment, and industrial output are all trending downward, pointing to a deeper recession in the future than the one we are now experiencing. Although current inflation, national deficit spending, higher interest rates, and stock market weakness appear to fit the variables that will tie into the 2030s. ITR Economics' long-term forecast for a severe business decline beginning in the early 2030s is not being pulled forward. As for those factors, inflation, the economic cures for COVID, supply chain disruptions, and most recently, the Ukraine conflict are all significant drivers of the current inflation. Experts do not anticipate inflation to be the primary driver of the steep decrease in the 2030s unless it becomes more systemically prevalent and compounds faster. Debt to the nation. Experts believe that the factors leading up to the decline in the 2030s are inextricably linked to the relentless growth of debt and deficit expenditure. Although budgetary imbalances and fiscal pressures in the 2030s do not now exist since interest rates are still historically low, this notion is supported by the path of the 10-year U.S. government bond yield, which has recovered from COVID but has since stopped. Rates of interest. The Federal Reserve is expected to raise interest rates amid declining inflationary pressures. By the early 2030s, rates will have risen to levels that will be very problematic for both consumers and companies. Experts expect a recession in the United States around the middle of this decade due to fiscal and monetary weaknesses. The recession in the middle of this decade would be severe, but it wouldn't be as bad as the Great Recession of 2008-2009. No glaring structural inequities suggest the mid-decade slump is a forerunner to the 1930s. Many of the experts' foundational tenets of the impending collapse of the 2030s are still under development. Examples of these are the demographic imbalance we want, with its attendant pressures on public programs like Social Security and Medicare and private ones like healthcare, is not expected to materialize for another decade. The bond market extracting a significantly larger premium to compensate for rising risks, the amount of the U.S. national debt producing relentless pressure to increase taxes, and a rate on a 10-year government bond that is at least 5% above the current rates. Some businesses and investors may be hesitant to invest in the people, skills, and tools necessary to take advantage of the current possibilities that will be available after the recession of the prior decade ends. Investors who shift from creating wealth in hard assets and equities and move too soon into a strictly defensive position using the sovereign bonds that are recommended for the 2030s stand to lose market share to competitors who see or believe that a recovery is taking shape mid-decade. To make the most of the next 8 years worth of upside potential, it is crucial to grasp the timing and relative magnitude of the impending cycles. By realizing that the disaster in the middle of the decade is just another phase in the normal business cycle, top management can employ tried and true business cycle strategies to weather the storm and emerge on the other side, or at least make an informed choice about what aspect of the market's top and bottom line performance to prioritize. In the 2030s, investors may not have as many alternatives. And that was all from my side to guide you on why the market is crashing and if we will see a next Great Depression. Please subscribe to this channel and press the bell icon if you're new to the channel so you don't miss any new stuff.